Good day and welcome to episode 1984. Now, that of course reminds us all that we must read or reread or watch a video on or watch the movie. I think there have been several adaptations of George Orwell's famous book that has sadly come true. 1984. Also, check out Animal Farm. Those are two fantastic books. And while you're at it, check out Fahrenheit 451, Atlas Shrugged, and I could go on. But there are some great books that have warned us about what is to come decades in advance. And we have arrived at that point, unfortunately. But hopefully we will keep the powers that be at bay and freedom and liberty will reign throughout the world. But sadly, I'm not very optimistic about that, largely because of technology. Technology is so scalable. It allows for a massive reach in terms of freedom or control. And we have these powers that be trying to control things. We certainly see this in the realm of the central bank digital currencies, which are very much a concern, and we'll continue to report on that. But today, we have got a guest with us to talk about demand imbalance arbitrage. Yes, this is a stock market oriented guy. Roger Khoury had a very interesting discussion with him. He will talk about demand imbalance arbitrage. And the question is, can you use this to understand the real estate market? Now, when you talk about real estate market, there are, of course, multiple geographical real estate markets, but there are also two major sides to the real estate market. One that everybody's always talking about, and the other that people neglect to mention most of the time. So one is, of course, the for sale market. How many buyers are buying? What is the demand imbalance arbitrage in that market? Will prices go up, down, or be stagnant? And then there's, of course, the rental market. And the rental market is usually non-correlating with the sales market because when sales are good, rents tend to be suppressed. Now, this isn't always completely true because there are geographical areas that are imbalanced due to migration trends after we saw after the lockdowns. So things are complicated, no question about it. You got to peel back the layers to the onion. But I just want you all to remember to not talk about the real estate market as if it's only about prices going up, down, or sideways. It's also about the income side of the market when you're an income property investor. Very, very important to realize that. And before we get to our guest today, and I also want to play a little clip for you. Well, I'm going to play two clips. A little clip for you from a fantastic movie we have talked about before. And let's see what this clip can teach us about the current situation with the banks and the broader economy and the markets. But first, let's talk about this demand imbalance arbitrage, not from the way our guest today is going to talk about it, but just generally the way a prior guest has been on the show. This is Barry Habib. He's been on the show a couple of times over the years. He's a mortgage person and does a lot of forecasting on the mortgage market and the real estate market. And here he is with his thoughts on the real estate market. This is only maybe a week and a half, 2 weeks old, something like that. Do you think he's being too optimistic? Tell me what you think of this.
It does not have to go down. They say what goes up must come down. Not necessarily with housing. Yes, housing has gone up over the past couple of years, but does that mean it has to go down? No. Look, after 121 consecutive months of home price appreciation, we've seen a bit of a lull. Down 1%, down 2.7%. It really depends on where you are, but those are the two best measures of home price appreciation. But it's about to turn. When rates turn around, people will come into the market in a low inventory environment.
Now that I agree with, by the way. He is right on about that because think about what we've got. We've got a low inventory environment. in the vast majority of markets. Really, well, in all of them, we've got lower than normal inventory. But we've certainly seen, remember, three types of markets: linear, cyclical, and hybrid. We've certainly seen in the cyclical markets some decent size inventory increases. We've seen them a little bit in the linear markets and the hybrid markets, but not nearly as much as before. And remember how misleading these statistics get, because they'll say something like, well, inventory is up 50%, but they're only saying it's up from where it was, which was historically low. So you got to understand that. But when rates do swing back and they drop again in a low inventory environment, I do agree with Barry that that is going to ignite the market. And I think that overall, the Fed is going to push us into an official recession. And as they do that, they will reverse course, they'll pivot, and we will see rates come down. We will still have low inventory. And remember, the housing market can act differently from the broader economy because it's such a necessity asset class.
Let me tell you something. When you take a look at the last 81 years, home values, what's the record? 73 years up, 7 years down, one was a tie. And there were periods.
That's interesting. 73 years up. Okay. I mean, think about the stats there, and only one was a tie. You really got to just parse this back and be careful of how much the headlines influence you, and be careful how much the naysayers that are usually jealous because they missed out, how much they influence you.
The time that you've seen in 6 years, home values go up 118%. Did it go down after that? No, not for the next 43 years it didn't go down, and then it went down just by 1% after that.
By the way, if you're watching on video, please do pause this video and grab a couple of screenshots of the charts he's showing, because they're pretty interesting.
We've seen periods like this, and we're in one now. See, everybody focuses on the time frame where we saw the housing bubble, but that was because of demographics. That was because of high inventory. It's different now. And also, what was the mortgage application? Fog up a mirror, you're approved. Do you have a pulse? You're approved. We don't have anything like that right now. It won't go down, just like the champ, because housing is the champ. Don't bet against it.
Housing is the champ. Don't bet against it. Now, I do think overall, though, he is a little optimistic, a little overly optimistic there. And the analysis, I think, is a little bit simplistic, but I think he's mostly right. You know, I do think, you know, we've already seen some decline in some prices. We're certainly going to see more of that, in my opinion, in the cyclical markets especially. But overall, I mean, look, folks, we don't do this as a speculation. We don't do this as, you know, looking for what's going to happen tomorrow or in 6 months. The process of investing, by definition, is the legitimate process of creating value over time. This is not your lunch money. You don't need it back tomorrow. So getting in the market in good quality properties that have universal demand. Everybody needs housing. We have a housing shortage. It is a good plan, and it certainly has proven itself to be the most historically proven asset class in history and everywhere in the world. Well, except for Michigan, except for left-wing controlled areas where people are leaving because they're so business unfriendly. So we've got to always watch our geography and be in landlord-friendly and business-friendly markets, of course. And those are usually the good, solid, linear markets with lower land values, lower prices, better cash flow. All right, so let's get to this clip, and then we will get to our guest talking about demand imbalance arbitrage. Okay, so here's the clip. It's from the movie Margin Call, and this was such a great movie. I remember when I saw this when I lived in Arizona, and I talked about it. This was maybe this movie's what, 9-10 years old now? Maybe it's a little older than that, actually. Time is going faster than you think, but this is a great clip. So check this out. The question here is, and comment below if you're watching on video, does this apply to the current situation we have with the banks and the brokerages today? It's pretty interesting.
Thank you all for coming in a little early this morning. I know yesterday was pretty bad, and I wish I could say that today's going to be less so, but that isn't going to be the case. Now, I'm supposed to read this statement to you all here, but why don't you just read it on your own time, and I'll just tell you what the fuck's going on here. I've been here all night, meeting with the executive committee, and the decision has been made to unwind a considerable portion of the firm's holdings in several key asset classes. The crux of it is, in the firm's thinking, the party's over as of this morning. There's going to be considerable turmoil in the markets for the foreseeable future. And they believe it is better that this turmoil begin with us.
So I don't think anybody really knows what company this is supposed to be. Maybe it's Lehman Brothers. That's a possibility for sure. But I don't know. If you know what company this is supposed to be, maybe it's Goldman Sachs. Who knows? Comment below and let me know if you're watching this on video. But here's basically what he's saying. Look, they discovered that they've got this portfolio full of toxic mortgages, toxic mortgage securities that are going to go bad in mass because they gave out the ninja loans, no income, no job, whatever, right? The liar's loans. And it was very, very reckless. Some loans were sold many, many times. So there was really only one loan in this pool of securities. Remember, that loan is an asset to the buyer of it, right? Because it represents a stream of income, that mortgage loan. And so they pooled these assets, and many times the assets weren't even in the pool. They were in many, many pools. So the question is, who actually owned it? Who actually owned it, right? It was just such a fiasco of disgusting greed on Wall Street. Wall Street, hey, it's the modern version of organized crime. But what they decide to do after having this all-night meeting, you've probably seen the movie, hopefully you have. If not, watch it tonight. What they decided to do is lead the market down by unloading these toxic mortgage assets as quickly as they could and hopefully just get out of them as their ship was sinking.
As a result, the firm has decided to liquidate its majority position of fixed income MBS today.
So MBS is mortgage-backed securities.
These are your packets. You will see what accounts you're responsible for today. I'm sure it hasn't taken you long to understand the implications of this sale on your relationships with your counterparties, and as a result.
So basically what he's saying is, we're going to sell these people assets we know are bad. We're going to sell them crap, and that's going to ruin the relationship, obviously, when they realize they bought crappy assets. So it's a game of hot potato. They're basically unloading the toxic assets without proper disclosure and screwing over their counterparties, right? They're getting other people to buy the junk. And soon, very quickly, the market will discover how toxic these assets are.
On your careers. I have expressed this reality to the executive committee, and they understand. As a result, if you achieve a 93% sale of your assets, you will receive a $1.4 million one-off bonus. If the floor as a...
So sell off all but 7% of your book of this toxic crap, and you'll get a huge bonus, over $1 million.
If the floor as a whole achieves a 93% sale, you will get an additional $1.3 million apiece.
Wow.
For those of you who've never been through this before, this is what the beginning of a fire sale looks like. I cannot begin to tell you how important the first hour and a half is going to be. I want you to hit every bite you can find. Dealers, brokers, clients, your mother if she's buying. And no swaps. It's outgoing only today.
So what he's saying is, we're not going to swap anything. It's just selling. Okay, just sell it to anybody you can. Sell these disgusting, crappy, toxic assets that are just junk. They're worthless.
Obviously, this is not going down the way that any of us would have hoped, but the ground is shifting below our feet. And apparently, there's no other way out.
So what's the comparison to what we have today? Well, we don't have this problem in residential mortgages today, but we do have this problem to a much smaller extent in commercial mortgages. Why? Well, it's not that we have the same cause. We have a different cause now. We have COVID and remote working and how companies just don't need the kind of office space they used to need. We also have the layer on the retail apocalypse. It wasn't really going on during the Great Recession in 2008. Okay. I mean, it was coming, right? I saw it coming in the mid 90s. I've talked to you before about that conversation I had at the Pacific Club in Newport Beach, California. This is this cool private social club. I was glad to be a member of it for many years. And they used to have these little small get-togethers and presentations there with these various bigwigs in the business world and so forth. I remember one of them was all about commercial real estate, especially retail commercial real estate. And I remember asking the question, and this was in the mid 90s, okay, keep that in mind. Aren't they worried about the internet taking away the business from the retailers? That was way in advance. Actually, that wasn't in the mid 90s. I'm a little premature on that. That was probably in 1998. I can always remember everything by where did I live, who was my girlfriend, and what kind of car did I drive? And what company did I work for? Was I still working at Remax, or did I have my own company by then? Right? There's all these like reference points in life of how you remember what year it was, right? Do you do that? That's the way I remember everything. Okay, so we have that as a difference. We have a lot of CMBSs, commercial mortgage-backed securities, not MBS, which are referring to residential mortgage-backed securities, but commercial mortgage-backed securities are a problem. There is some toxic debt there, but again, this is for a different reason and to a much smaller. But that doesn't mean you shouldn't worry about it because, the banks, a lot of the banks own these assets. So it's important.
Guys, this is obviously a very, very unique situation. If we are successful today, we will have been successful in destroying our own jobs. I cannot promise that any of you, all of you, some of you will be repositioned within the firm. But I can tell you that I am very proud of the work that we have done here together.
Very proud. Let's sell our toxic junk and unload it onto the world.
I've been at this place 34 years. And I can tell you from experience that people are going to say some very nasty things about what we do here today.
As they should.
About what you dedicated a portion of your lives to. But have faith that in the bigger picture, our skills have not been wasted. We have accomplished much, and our talents have been used for the greater good. Here's your packets. Get to work.
You can convince yourself of anything about the greater good, I guess. Well, anyway, you get the idea. But watch the movie. It's such a great movie. If you've already seen it, see it again. It's just a fantastic movie. Anyway, let's get to our guest, Roger Khoury, and talk about demand imbalance arbitrage. By the way, look forward to seeing all of you who are in the mentoring program on Wednesday. Look forward to our weekly Zoom meeting always. And here we go with our guest. It is my pleasure to welcome Roger Khoury. He is the creator of Demand Imbalance Arbitrage, and we're going to look at some home builder stocks today and learn what that might be teaching us about the real estate market. This is something we have not done before, but we're going to look at some broad stock market indices anyway, to just look at the broader economy as well. Roger, welcome. How you doing?
Thank you. Good to be here. Appreciate it.
And you're coming to us from Austin, Texas, right?
Correct. Yeah.
Excellent. Well, tell us about your methodology and I mean, what is demand imbalance arbitrage? That's a mouthful.
Yeah. So arbitrage is basically the ability to take advantage of a difference between two points, right? So, for instance, what I developed is a forecasting model based on real-time demand, and that allows you to have a tremendous level of control over your analysis and understanding what positions, what investments are likely going to work out before you commit to them. Because most people kind of take a position that they're interested in because of something they've heard, they're hopeful about, or maybe there's fundamentals, or some people you will use technical analysis if they're involved and like to dabble in the financial markets directly and have an active brokerage account. But they don't know before they commit to an investment whether it's going to work out or not. They just have this hope. And that's what causes a lot of stress, and that's where a lot of the inconsistency occurs. So with demand imbalance arbitrage, what we're doing is we're looking for significant imbalances between where the price is versus where the actual demand is. And if you think about it like a rubber band that stretches out, right? If a rubber band is kind of stretched out a little bit, yeah, it's going to snap back, but it has room to continue stretching further away. And so what we do is we teach investors how to look for significant imbalances where that rubber band stretched out so far out that there's a very low probability, low risk for it to continue further away. That's got to come back and snap back and go to where demand is, because all price movement is based on where the demand is. So as demand fluctuates up and down, price always follows. So people don't realize that price is a kind of a lagging indicator. Mm-hmm. And so what happens is the price is always following where demand is. And so if we can focus our attention instead, not on the price of things, but where all the demand factors combined are at, that helps us see an accurate picture of what we can expect price to do next, because price is going to be following demand. Demand is the only objective leading indicator in any market. And so today I hope to kind of display that for everybody, kind of show you a little bit how that works.
Okay, good. That makes a lot of sense. But before we go into demand imbalance arbitrage, maybe you can just give us a broad view of, and I know there's like a limitless number of these things, right? And when I say things, I mean schools of thought or investing philosophies. So, I'll rattle off a few. Of course, when people are investing in the stock market, or a lot of these apply to other asset classes too, but there's fundamental analysis, technical analysis, value investing, momentum investing. It just goes on and on. But kind of talk to us about the overview of some of these like major schools of thought, if you will, or investment philosophies.
That's a great question. So every single one of those that you've mentioned are all based on past information. They're lagging indicators. So if you think about it, when we look at price itself, is a lot of people will say price is only truth. Wherever price is, that's the truth. So they look at price as the real-time indication of what they can expect. But then the problem is price itself is a lagging indicator to demand. Where demand goes, price follows next. So then these other indicators, momentum, fundamentals, technical analysis, all the different forms of technical analysis, charting, all those things are derived from price, what price did, and what data has been revealed, if it's a report on profit and loss, earnings, whatnot. So that's something that's kind of already happened. And so you have a lagging indicator on top of a lagging indicator. And this causes a lot of the hit or miss experiences where people have figured out some kind of an edge in the market that gives them kind of a strategic way to enter the market that they identify as an opportunity. The problem is any strategy you develop is going to necessarily be dependent upon the condition the market was in now and how it was before. So because all you could do is figure out, well, what's working now and how can I make it work so that it kind of works with previous scenarios. But the problem is that the market's always evolving and changing. So what works today, and any investor who's had any experience in the markets will know, they'll invest in some kind of a strategy, it'll work for a while, and then it'll start to work inconsistently, poorly, or not at all. And then they're off chasing the next new thing and what's working now, right? So, but if we shift away from the traditional schools of thought of having a focus on these the price of things and these lagging indicators, and we look at what demand is doing in real time, what happens is suddenly we've stepped away from being kind of thrown and tossed by the waves of the changes and evolutions in the market. And instead, now we can measure those things very much like a barometer, right? A barometer never needs updating. You can put it anywhere in the world, on top of the mountain, at the bottom of a valley, in cold weather, hot weather, and it's going to tell you the barometric pressure. It's always going to, it doesn't need to update. So you need a process that provides a predictable range of outcomes, right? And when you have that, now you can actually identify, measure, and value very quickly within a few minutes, kind of like if you sit in a car and you know you've got a 250-mile road trip ahead of you, and you look at your gas tank, it shows you've got a quarter of a tank of gas left. Well, you know instantly, without doing any calculations, that a quarter tank of gas is not going to give you 250 miles. So you don't have to be nervously driving down the road wondering if you're going to make it, and then the car stops on you. No, you just fill up, and you know you've got a confident road trip you can take for 250 miles. And so with demand, you can see, and let me show you here very quickly.
Okay, wait, before you move on though,
Sure.
and we're gonna look at some charts. So for those some people are only listening on audio, so you need to verbalize what the people on YouTube and other video platforms are seeing. But before we do that, I just want to say that there's a couple like buzzwords that apply in the real estate market with what you're saying. But more broadly, even before I say that, when I talk, and this is to all my regular listeners and viewers, when I talk about the Hartman Comparison Index, the index I developed, one of the key points to that is that when we look at these 40 plus items and compare them to the price of housing, is there is so much data in the price of anything.
Yes.
Right? The price contains a tremendous amount of wisdom because it is a derivative of the decisions of quite literally billions of people, billions of actors in the marketplace.
Correct.
That's what determines the price in most cases. Of course, there are distortions with governments mostly, but there's a tremendous amount of wisdom in price. And so the Hartman Comparison Index is using the prices of other things to compare to other things, right?
Correct.
That's what the HCI does. So with what you're saying with the demand imbalance arbitrage, is in the real estate world, we would look at that, we would compare that to maybe a couple of just buzz phrases like path of progress, in migration, okay, versus out migration, right?
Correct.
In migration would be the demand. Path of progress is a term developers, especially land developers, use a lot, that shows like this is where the development is going, right? And so you want to be in that path. So demand is the earliest sign. That's your thesis. That's the earliest piece of data you have is the demand data.
Correct. So actually, for those who are listening and aren't able to watch, I just want to kind of give a sense of going back to the car analogy. If we have a road trip, just visualize in your mind, you have 250 miles that your car's got to make. And so if you don't want to nervously be, driving and waiting to see when the car's going to run out of gas, when you have a quarter of a tank of gas, instantly that that's not going to get you there. So you go and refuel, right? So that helps you hit your target. And so when we put up on a chart, let's say any proxy, like whether it's an institutional landlord, like American Home Builders or Invitation Homes. If you look at the actual builders like DR Horton, which I've got on the screen right now, you've got KB Homes, you've got Lennar. Those are proxies for the real estate market. We can look and see kind of what's going on. It helps us understand where things are going in the real estate market. And so if we can look at the demand factors, and there's 8 major factors of demand that impact price, and when you combine them together, okay, it provides an incredibly accurate picture that allows you to be right about your analysis no less than 80 to 90% of the time. I developed this methodology back in 2010. It is kind of an innovative first in the industry, but since then I've never needed to update it, just never needed fixing, modifying, or tweaking. And because it's based on principles of demand, that are always going to be there. Demand's always going to lead price. And so most people will look at the fundamentals or the technical analysis aspect of what you will see on a chart. What we look at are 8 major factors, and technical analysis and fundamentals are just 2 out of 8. So that's why we get blindsided by these 6 other factors that we kind of think like, what happened? Where did that come from? Why did the market go differently than what I expected, right?
All right.
Let me just quickly mention those 8 factors to you. There's fundamentals, there's technical analysis, which includes, Elliott wave, Gann, Fibonacci, but you have geopolitical forces that include central bank and macroeconomic effects. You have volatility and its different phases and the different shifts that occur there. You have market sentiment. You have liquidity levels. Okay, that includes volume, order flow, trade flow, and in the real estate industry, like you said, the progression, right, where there's that path of progression is inflows, outflows, prime liquidity pools. These are essentially areas in the market that institutions love to target. And that's where sometimes people who are involved in the financial markets, who dabble with a brokerage account, they might feel like the market's rigged, it's manipulated. Well, these are areas that you can actually see where the manipulation can occur and can be taken into account when you understand the demand factors and take that into account. Then you have imbalances in supply and demand. So now you've got like 8 major factors. You put those together, you have a very powerful way to analyze any investment before you get into it and know that you're going to be right 8 to 9 times out of 10. And that's going to dramatically reduce your downside risk exposure without limiting your upside profit potential, if that makes sense.
Okay, great. So first of all, this chart on the screen of D.R. Horton, the home builder, and that's a popular home builder that our clients sometimes buy from through our network. And we've done tons of business with D.R. Horton over the years because they make entry-level homes mostly. Now, how long is this chart? What's the time span here?
So this is a weekly chart. I think that's a good
but it's more than a week. This is a lot more than a week on this chart, right?
Yeah, yes. Each bar is 1 week long, right?
Okay, got it. So how long is the total chart here?
So this is going back to 2019, it looks like.
Okay, 2019.
Yep.
Got it. One of the interesting things that I was saying, and I'm not a stock expert, but what I am quite good at, and people are telling me, is I just have a good sense of markets. Yes. Of understanding demand and supply. And, when the home builders got beat up to a pulp in the stock market a while back, I was talking to some of my friends that know more about stocks than I do, saying, look, I don't think it's fair that KB Homes and D.R. Horton and even Lennar to a lesser degree have been so beat up. They've been sort of mixed in the whole asset class of home builders because there is a giant shortage that I live every day in my career of entry-level housing. There's just a massive shortage. And you can't compare that to Toll Brothers that builds high-end homes that are super soft and going to soften further. I think D.R. Horton was like $40 or something back then. And, a bunch of people talked me out of it. Of course, I didn't do anything. And now it's higher, I think, right? What's this show us?
So I will tell you that is a very common kind of approach, to the markets as people will kind of, work hard to kind of do their research and understand, kind of have a good sense about things. And that's generally how a lot of investors will go about an investment. They have a good sense about something. Yeah.
I just didn't think it was fair that these low-end home builders were lumped in with all the other home builders when they got bashed, because right. I just knew that their product is in demand and the high-end builders product isn't in demand. There's a glut of that.
Correct. And one thing that I like to help people kind of become aware of is the empowerment of having a process that is objective, that's reliable, that's repeatable, that's consistent, that's accurate, because now you have a way to no longer have to lean on your gut or your sense, but you have a process that, because process is what gives us a predictable outcome, right? Just that's how franchises succeed, because we know that we've got a reliable process that is replicatable. Yeah. And so if you can take that to investing, look what happens. As an example, if you have a long-term portfolio, I want you to think about, just money. And when you are invested, if you're either productive or you're not, right? And so if the money is kind of paralyzed, inflation is eating away at the value of your money. So why not, instead of having to sit back and hold on to a double-digit downturn and then nervously hoping and praying it's going to recover, we have to remember, by the way, the Nikkei, the Japanese index, after it hit an all-time high,
1989.
It never recovered. I mean, it took 30 years to come back to recover to those highs.
But Japan is a special case. Okay. Like, it's funny. We economists always kind of talk about this, and we talk about the other countries, we sort of talk about the East and the West, the, different hemispheres, the industrialized countries, the non-industrialized countries. But then there's Japan and Argentina.
Yes.
They're their own case because they're just they're so different. And of course, I just got back from Japan a week and a half ago, but they just have a giant demographic problem. So, it's different, but I get it. But Hey,
But
I
but
don't
I
want
just
to
want to
get,
address one
yeah.
thing. I just want to say the idea that it's different, that's where we get in trouble is
Mhm,
we think because we have to realize we're moving into a very uncertain territory now. Post-COVID, COVID really
mhm.
changed
Yep,
the playing field, right? And
sure.
so I want us to just rather than depend on being, kind of spoiled in this country where things keep coming back and recovering the highs. What if we've entered a season now where it's no longer going to do that?
Oh
And
yeah,
so I want to empower people to know
no question.
how to navigate that kind of environment and not feel so uncertain, bring a little more certainty into their investing futures. That makes sense?
Absolutely, and I do agree with you that the world has changed quite dramatically. But let's get back to the specifics. Let's look at that DR Horton chart if
Yeah.
we could, and
Yes.
give us your analysis of that. Is this the same chart just in a different time period
Yeah.
now?
So this is DR Horton.
All right, what's it tell us?
Each price bar is a week long, and I want to just point something very important out to you. Now, there are multiple steps in the process of analysis, and it takes 4 to 6 weeks to learn. So I can't go through that, but I can give you kind of a slice of the pie and give you kind of a very oversimplified understanding, so you get a sense for how visually intuitive it is. Okay, but just like that, the gas tank analogy. But let me show you something here. When DR Horton was at a high, okay, right over here. Let's look at this real quick and see what happened when it came back and it pulled back into this area here. I want you to notice that this down below are the 8 major demand factors combined. Okay, so all the 8 that I went through, that's a visual representation of what's happening with demand. So what we can see here is demand fell below all these areas here. If you look at from this area here, this, and in fact, that was the low there that it went to, okay, that it went below. So we're going to look at that and we're going to mark that area here, okay, with a line. And that gives us an indication at this point in time, right over here, where the market pulled back. That's telling us demand has shifted so radically below previous areas here that we're likely going to see a reaction back up. Generally speaking, we'll look at where this was last time, and we can project forward and say that the market's likely going to recover up to this area, and somewhere in that area, I didn't stick, let's make that stick, somewhere in this area here, when the market comes back up, we should be looking at taking off, some of our position, or going short, or going into cash, because we can expect a significant push back down into these areas. And generally, by the way, you're going to see this kind of swing high, swing low combination. You see where it went sideways there, right? So we can kind of project that forward and kind of give us a visual representation of the area in price that we can expect price to fall down to. And so once the market recovered up to that area, you knew right then and there that you had an optimal time to get out, because the market was going to drop at least 20%. Why hold on to that and wait for that to recover? That's paralyzed capital. It's better to go into cash, and then when it comes down, look at this. Once it bottoms, you can see how it shifted, demand's shifting back up again. You can come back in and ride the move back up. Do you see the wisdom of that? Now your capital is being used much more efficiently, much more effectively. And for those who are kind of looking at retiring soon, they don't have to be stuck with this downturn that then eats away years worth of productive.
Got it. Yeah, I mean, yeah, that goes without saying. But so your definition of demand is a lot of buyers for the stock, right?
It's the 8 factors we talked about and their impact on price, right? So
Okay.
we look at that and we see, well, where's that showing? Where's demand going? So as demand, so if you look at this down here below, you'll see that it fell below this area here. Well, where was that area? That area represents an area where price was being held by the market, and basically we call that support. It's being supported. People were willing to buy here. So that means that demand has to come in and interact with that area, okay? And there's a lot of steps in here, but I just want to simplify this. So we can say objectively that price is likely, with an 80-90% probability, going to fall into this region here, okay, from the highs, because demand, when it was over here, was telling us it had shifted down to when it was back down at this price level. So now, because it's come down so far, typically the market will react. You'll have one more rally, you have one more set of buyers. but you can see demand that they're not going to be able to overcome the majority of what was there that had shifted down and had an interest in the market going lower. So you have an opportunity to let the market recover. You get an optimal exit. We have a kind of an objective area that minimally is going to, we can expect the market to come back with at least an 80-90% probability. And then we can take an exit right over here in this area here. Okay. And that saves me from that. And I can show you, we'll go through all the other, we'll go through some of the institutional.
But what I want to know is that the chart on the bottom,
yes,
that is showing exactly what?
It's a visual representation of the 8 major demand factors.
Okay, it's taken into account all of your 8 things. So you have developed this piece of software, I'm guessing.
It's a process. The indicator that down below is a helpful, indicator that takes all that into account. So I don't have to sit and spend, half an hour pulling on all those resources.
That indicator is not just an indicator of momentum. In other words, how many people are buying the stock.
Correct. It's what is correlated into that indicator, all those 8 major factors visually represented and their combined impact together.
Some of those factors, though, that you mentioned, like, for example, the geopolitical situation, those are soft things. I mean, they're not soft in the way you'd mostly mean them, but they're not quantifiable.
Well, you're talking about central bank influences, so that takes into account interest rates, right? Which is a direct factor, right? You've got all the macroeconomic effects. So it does take into account some of the very important factors that are going to affect, the mortgage industry, right?